We need to start on the litigation expenses. $1.5 billion for the quarter, making it the second straight quarter in which major legal costs hurt earnings. How far along is the firm? Where is the firm in determining how much more legal liability there is? Are you in the second inning, fourth inning, eighth inning?
Yeah, so it's tough to talk about active litigation, but I can tell you that the cadence of the charges that we've taken, given that they reflect probability and estimability of likely outcomes, suggest that things are moving along. We're having very constructive dialogue with people on the other side, and these include, as you would suspect, previously disclosed sales practices related matters from a few years ago. So they do obscure the story from the quarter. You know, there were some really good fundamentals in the quarter, like with some of the other banks, but in loan growth and deposit growth and payments related income and debit and credit card, investment banking was stronger. The mortgage business was stronger. So a lot of the underlying drivers actually working out pretty well, but we had some idiosyncratic things unique to Wells Fargo that hit in the quarter.
You say idiosyncratic. Do you expect charges like this to continue in 2020?
My expectation is that our operating losses will look more normal in the future than they have in the recent past. But you know, we, as I said, probable and estimable is the approach that we use for recording those. And let's let some time pass and watch how it unfolds.
John, you've now been the CFO at Wells Fargo under 4 different CEOs. How would you characterize what's different and how Wells Fargo operates differently under the new CEO, Charlie Scharf?
Sure. So Charlie has had a range of experiences from other GSIBs and from Visa, as you probably know. And so he's also been a CFO. So he thinks about things in very financial terms. He's a very quick study. He's got a broad range of previous analogous experiences in the risk and control and regulatory relationship related front. So I would say very optimistic. He struck a very thorough tone today on the call, talking about all that he's learned in the risk and control front thus far, and how much work that we have to do. And I think he's got a good sense of that already. But he also made the observation about the durability of the franchises and the possibility for growing them. And so, on the one hand, I think it's an advantage, frankly, having somebody who has been through this at other firms to take the reins now as we really execute and deliver against some of our regulatory commitments. And I also think it's great to have somebody who's had the range of commercial experiences as we continue to grow our underlying businesses. So, so it's a plus.
So as you deal, John, with those regulatory and legal issues over the course of the year, talk to me a little bit about the consumer side of the business, because consumer spending has been a huge story here. It appears that we aren't stopping our spending, and we've seen other banks get a pretty decent earnings boost because of that consumer spending. This wasn't necessarily the case for Wells Fargo in the fourth quarter. Is that going to improve, or do you anticipate it improving going forward for Q1 and beyond?
Sure. Well, the business itself, there's lots of different pieces to it, but debit card income up 6%, or pardon me, spending on debit cards from our customers, and we're the largest U.S. debit card issuer, up 6%, 4% in credit cards. We saw growth in auto loans, growth in credit card loans, growth in first mortgage loans, both those that we put on our books as well as those that we package and sell to the agency. So a lot is happening across the whole waterfront of the consumer side, and it is a contributor to revenue in our business.
All right, well, as you mentioned, there were some highlights in the quarter, and you cited positive loan growth. Having said that, you're still lagging behind your peers there. How do you envision closing that gap, particularly in consumer banking, which has been driving the results at your rivals?
Yeah. So on the loan front, you know, we have almost $1 trillion worth of loans, and we're in the same neighborhood as our largest peers. So that gap isn't so different. We sold or designated as held for sale almost $10 billion worth of loans last year. We still had some pre-crisis loans that we needed to dispose of, and have finally done that. So the quarter-to-quarter estimation or comparison of loan growth rates is probably a little bit more heads up now that we've done away with that. But our auto business is one that will probably grow faster than peers. We'll grow as fast as peers in mortgage. Our credit card business is smaller. We wish it was bigger. It should be bigger, and it will be bigger. But today it's smaller. So even if it has rapid growth rates, it's not going not going to generate the same types of dollars of outstandings as some of our peers as we sit here today. And on the commercial side, which is about half of our loan portfolio, there's been more growth at the higher end in the corporate and investment banking related relationships from large cap companies and other market participants who borrow from us, and a little bit less growth on the middle market or commercial lending side of things, just reflecting, I think, a little bit of a standoffish approach to risk taking on the part of that part of our clientele, and that's been true for a period of time, and I think it was true with peers as well.